The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick, and these are your headlines. Nvidia announces a $100 billion investment in Open A.I as the company's partner on AI data centers. CEOs Jensen Huang and Sam Altman join CNBC to discuss the deal.
This is the biggest AI infrastructure project in history. This is the largest computing project in history.
The compute constraints that the whole industry has been in, our company in particular, have been terrible. We're so limited right now in the services we can offer. There's so much more demand than what we can do.
The Dutch chip equipment maker ASMI lowered its full-year guidance, citing weaker than expected demand in two key units. And recently appointed Fed Governor and Trump ally Stephen Miron lays down the gauntlet for the Fed. He is actually part of the Fed nowadays, calling for rates to be slashed by nearly 2 percentage points.
The Federal Reserve has been entrusted with the important goal of promoting price stability for the good of all American households and businesses, and I'm committed to bringing inflation sustainably back to 2%. However, leaving policy restrictive by such a large degree brings significant risks for the Fed's employment mandate.
Very good morning to you all. In fact, I love our headlines once again. Our producers, led by the doughty Mike, have once again nailed it as well, because not only have we got the big Nvidia story, we will come to that in spades in a few moments' time, but we've also got the end of the mystery. Because 24 hours ago, I couldn't work out where the erroneous dot had come from. It turns out
puzzled?
It turns out it was Stephen Miron who wanted 2 percentage points lower for interest rates. How extraordinary!
We call it the Miron dot now.
Wow.
The Miron dot on the dot plots.
I mean, there's something wrong, isn't there? Because the rest of the policymakers think we're roughly where we should be in interest rates at the moment. He thinks we should be a couple of percentage points lower in a very short space of time. Anyway, that's one story that the market is, as you said quite rightly last week, deciding it's a Goldilocks, even though I dispute that intensely. The other story, which is kind of Goldilocks, but only maybe for a very specific number of companies, is this Nvidia-OpenAI story.
In some ways, is it the too hot porridge that's on the table? What we're seeing from the technology universe.
How big is that porridge pot getting?
Oh, it's huge. and it's the same players being stirred around the pot. Ooh. So if you take all the players out of the pot, what happens? Shares in Nvidia closed almost 4% higher after the chipmaker announced it will invest up to $100 billion in OpenAI as part of a data center build-out project from the ChatGPT maker. The project aimed to deploy Nvidia systems using 10 gigawatts of power, which is equal to between 4 and 5 million graphics processing units. OpenAI will use Nvidia's investment to buy chips from the company as part of the data center push. Nvidia's investment will be made in tranches, with the first $10 billion due after the first gigawatt is deployed. Nvidia CEO Jensen Huang said the investment will reap rewards.
This is additive. This project, 10 gigawatts of AI infrastructure, is additive to everything that has been announced and contracted. Remember, they've contracted huge amounts of capacity through Azure, through OCI, through CoreWeave. And all of that is powered by NVIDIA, and we're really delighted working with all of these partners. And that's going to continue to grow.
OpenAI CEO Sam Altman said the AI industry is currently being held back by a lack of compute.
The compute constraints that the whole industry has been in, our company in particular, have been terrible. We're so limited right now in the services we can offer. There's so much more demand than what we can do. And as we look forward another year or 2 years, if you have, let's say it takes 10 gigawatts of compute or 5 gigawatts of compute, you could choose one of two things. You could choose to cure cancer by having AI do a bunch of research, or you could choose to offer free education to everybody on Earth. No one wants to make that choice. And so increasingly as we see this, the answer is just much more capacity so that we can serve the massive needs and opportunity with this.
Arjun joins us around this mega deal. Arjun, there are so many questions, but the number one I have if I'm going to be negative about the deal and bring up some of the concerns, it's just how circular now some of these deals are. Nvidia needs customers to buy its chips. And the reality is it's fueling some of those customers so they have the capabilities to be able to buy their chips. He mentioned, Jensen Huang mentioned CoreWeave, that's one of the others, and now OpenAI, another company they're going to be investing in that will be able to buy more of their chips.
All roads lead back to Nvidia.
Exactly.
Is how it is. I mean, even if you think about the infrastructure deal quite recently between OpenAI and Oracle are buying Nvidia chips, which also leads back to Nvidia. So it is circular. I think what the market's trying to figure out is Nvidia said this is additive to what they've already announced. So they're trying to figure out how is this going to benefit Nvidia if they're basically giving money to OpenAI in return then to go and buy out Nvidia chips. And one of the comments I've seen sort of focused on was one Jensen Huang made a few weeks ago during the earnings call. And he was talking about what it costs to bring a gigawatt of compute power online. And he said this costs between $50 and $60 billion. And he said that of that, Nvidia is $35 billion. Now, if we do some of the Nvidia math here,
it's a special math.
Yeah, it's a special math. Nvidia is effectively giving OpenAI $10 billion per gigawatt. So that leaves for the Nvidia portion $25 billion to be found somewhere. So that's kind of what the market's looking at this point in time, seeing that actually Nvidia will profit from this. But key to this is not just this deal, it's how it cements Nvidia right at the continued center of this AI infrastructure build out. And it's not just the GPUs, it's the networking equipment that comes with that. It's these developers building on the CUDA software stack as well. And that all becomes very important to the longer term position of Nvidia.
I want to get into the competition because there is a view that, look, with the might and the advantage OpenAI has with this type of deal, it entrenches its software in the race towards AI. It entrenches the chip technology that Nvidia has, makes it very difficult for other rivals to get into the game. But let's talk about the rivals, because some of the rivals, just if we look at the space around the hyperscaling and around platforms, and that is Microsoft and Google. Microsoft has been one of the biggest buyers of Nvidia chips so far. They've been working on their own line of AI chips as well. Where does this leave the competition that might be somewhat annoyed about the teaming up of Nvidia and OpenAI here? Do you think Microsoft and Google try and go at their own in some of these areas?
Yeah, look, Microsoft and Google would love to have an entire sort of stack for their AI technology, but I think this is quite clear from a deal like this that Nvidia still remains the gold standard here when it comes to the type of chips required to train up and deploy these artificial intelligence applications. And so one of the interesting moves yesterday after this deal was Broadcom stock was slightly down as a result. And Broadcom is a key player in helping some of these big hyperscalers to design their own chips. And so that sort of was a sort of a view from the market here that actually perhaps those self-designed chips that Google and Microsoft and others are working on just still aren't quite there yet. And also, it's not just the level of those chips versus what Nvidia is bringing, it's the ability to scale that and deploy whole data centers with that. But if you look at, again, the early mover advantage from Nvidia, a lot of the infrastructure so far that's been built has been built exclusively pretty much on Nvidia chips. AMD was, a little bit later to the party. They're still not seeing orders anywhere near on the magnitude of what Nvidia is seeing as well. And so it's very much creating this infrastructure layer that is built so heavily on Nvidia. You will see some of the custom chips from the hyperscalers come into the equation, but as it stands right now, it's Nvidia that will make up the majority of the infrastructure.
One thing we do know is that tech titans don't always see eye to eye with the administration. And that there's a wonderful oscillation between the relationships with, you can name them all really, Mark Zuckerberg, Tim Cook, certainly Elon Musk, Jeff Bezos certainly. They all have incredibly oscillating relationships with whichever administration, but for this administration we'll call it Mr. Trump as well. Sooner or later, Jensen Huang will do something that upsets Trump, or Trump will do something that upsets Jensen Huang, whatever. And then there'll be questions about the size of this company as well. Is this another monopolistic situation in the making that is going to raise the ire of politicians, and I'll say this, on both sides of the Atlantic?
Look, Jensen Huang has played such a good game politically, I think, so far.
So did Elon Musk.
So did Elon Musk, you're right. But Jensen Huang Elon Musk was very different. He went right into the heart of the administration, literally into the White House. Jensen Huang has played a more tactile game, I'd say. Also trying to keep both sides.
Sure,
and both sides,
the
talking China.
dominant position that Nvidia has when everyone's making money and everyone's happy and it's America first is great. When things start cracking at the sides, we know people turn on each other. They always do.
And there's always that volatility under this current administration. Right now, what Nvidia's done well is and Jensen Huang has done well is position itself as, to some extent, America's white knight in this AI race against China. And that is the narrative that he's managed to convey across to the president. And so far, in terms of the president's agenda to push American technology over Chinese technology, that has been key.
That's the point,
if that changes.
Yeah, that's the point. What competition? The competition is overseas, and that's what the administration is focused on. It's not worried necessarily about the competition at home. Other administrations may be down the track, and if you had a different president in the White House and you had a different directive, maybe you would see some teeth come through from the regulator on the amount of deals from Nvidia.
And it's coming from Elon Musk as well. How furious will he be when he sees this as well, as he is every time he sees Sam Altman have another success, another win? The rank is already there. It's just a question of what bubbles through to the surface.
As will potentially Microsoft and Google could be completely annoyed about these types of deals. But who are they going to fight that fight with? What regulator? I mean, the regulator's had its teeth removed under this administration. It's not really shown any firepower, any willingness to push back against some of these competitive issues. More concerned about culture wars, effectively. That's been the predominant thing they've been concerned about when it comes to technology and media groups. So I would be worried down the track about competition being hampered by these Nvidia deals. And it is huge. It is the elephant in the room now. And let's not be naive about the amount of deals and how circular this is when there's a financial market that is not as open as the one we have today, a financial market that wants to back every AI asset, every technology play. If that sentiment turns, you see just how circular these trades are, then that could be a problem down the track. And let's just highlight that as a risk for investors only looking at the blue sky.
Yeah, I mean, the risk is there in terms of concentration. You think about Nvidia and on the earnings how much it said it gets from hyperscalers. A huge amount of its revenue comes from the hyperscalers. You think about CoreWeave as well. It's, again, relying so much on just a handful of customers. So that concentration risk in terms of customers across this infrastructure landscape is very much there. In terms of the regulatory point of view, I think you're right. Under another administration, some of these deals may have certainly had a lot more question marks. I think even if you look at Nvidia sort of buying into Intel as well. But because of the narrative around boosting America's technology and these critical technologies in trying to revive Intel, which is seen as kind of America's answer to TSMC, these deals have so far been allowed to go through. But that regulatory risk and I think that political risk is always there.
Yeah, absolutely. Arjun, thank you very much for that. Let's push on to some more tech, and shares of ASMI are sharply lower in early Frankfurt trade after the Dutch chip equipment manufacturer slashed its outlook for the second half of 2025, warning revenue will be 5 to 10% lower than the first 6 months of the year amid weaker than expected demand. Do you just want to come back in on this and what we're seeing? I mean, we've just been talking from one angle about how very strong the outlook is for a company stateside. Now, as we talk about a European player, why is the picture looking slightly different?
Yes, I think there were a couple of things at play here. One, on the 2027 outlook, which they reduced, was they were sort of putting that down to currency. But I think also we're hearing about all these chips being deployed. That doesn't necessarily immediately translate into success or profitability and revenue for those companies in the supply chain. That sometimes takes a longer time to do. So if you think about the Nvidia story, they're saying, look, we're going to deploy all these chips with Open A.I. Those chips need to be made from somewhere. That's TSMC for now. But then to eventually get down, TSMC may already have the capacity. We don't know what kind of capacity they need to bring on. It's only when we hear from the manufacturers, right, we need to build at XYZ amount of capacity, will we then get an idea of how much that will ripple down to the supply chain to companies like ASMI, but also ASML as well here in Europe. And so, that immediate big announcements doesn't always translate directly. And so I think for ASMI...
Translate to ASML share price recently.
It did indeed. They saw a very circular kind or cyclical kind of stock, ASML. They went down and now they've gone through a tough period over the last year and a half. And so there's sort of green shoots of a recovery there.
Exploded this month, the share price.
But there's not always that immediate translation to the rest of the supply chain. And so I think with ASML, it's Investors were already braced for kind of the tough guidance they had given for 2025, and so they're hoping to see recovery in 2026 for ASML.
Super duper. Thank you very much indeed. I was just doing my sums on various revenue estimates for 2026 for OpenAI and then extrapolating that with the understood market value of this company. Still quite a fruity valuation to sales. All I can say is it's eye-watering depending on what you want to do. Even if you believe they're going to triple their revenues in 2026. Extraordinary numbers. We'll revisit this. I've sent you a collab request on social media.
I will accept that,
We're
Steve.
all over it this morning.
We're all over it.
And they've already tens of views.
Tens of views. That's good. Better than normal, isn't it?
Thank you very much indeed for that. Right, let's take a look at the S&P. It moved higher on the back of the stories that we've just been talking about as well. So by and large, we've had records on the Dow, records in the S&P, and guess what? Yes, record on the NASDAQ as well. Interestingly, for those of you who are looking for breadth and depth in the market as well, the Russell 2K, yes, had its first record close. When do you think, Sid? Karen, I didn't know this. Do you want to play with it? Oh, there's no camera on you, I think. When do you think the Russell 2K has had its first record close since? So when was the last time it had a record close?
Oh,
I can't believe this. I had no idea. Long time.
Oh, really?
November
I would have said
2021, it says
that
here.
long, I would have said
on the
9 months,
CNBC
but
copy,
right.
yes. Russell 2K posts its first record close since November 2021. So there you go. All of you who think there's breadth and depth in the market, it just arrived. Of course, all eyes on the PCE data at the tail end of the week. Let's have a look at the Asian indices, ex-Japan as well. And what we have is a very mixed performance, with the TAIEX and the KOSPI moving into positive territory, the Hang Seng and the Shanghai Composite down in negative territory. Futures for Europe look like this. We are called mildly high. In fact, the futures are trading mildly higher across the board. Well, it was Myron. God, I'm so surprised. I did wonder who that dot was for the end of 2026, calling rates so much lower. It turns out it was Stephen Myron. I thought it was Jay Powell. God. Addressing the Economic Club of New York less than a week after his appointment as Fed governor, Stephen Myron laid out why he believes interest rates in the United States are too high. You won't believe this. He called for aggressive rate cuts.
I believe the appropriate Fed funds rate is in the mid 2% area, almost 2 percentage points lower than current policy. The Federal Reserve has been entrusted with the important goal of promoting price stability for the good of all American households and businesses, and I'm committed to bringing inflation sustainably back to 2%. However, leaving policy restrictive by such a large degree brings significant risks for the Fed's employment mandate.
Oh, I've just seen a very interesting flash on Orsted as well, which the producers will work on. It looks interesting for them. Let us move on. St. Louis Fed President Alberto Mussolem took a different approach to Myron. No way, saying he sees limited room for further interest rate cuts. You guys wouldn't expect anything else, would you, from these two gentlemen? Mussolem backed last week's move to lower rates, which he categorized as precautionary to support labour markets. However, the St. Louis Fed president said the central bank should tread cautiously, warning of policy becoming overly accommodative. On a programming note, our US colleagues will be joined by the Chicago Fed President, Austin Goolsbee, this morning. That exclusive interview is coming up at 1:30 London time. OK, coming up on the show, a new report shows the UK retains its status as a financial powerhouse, but warns it cannot be complacent. We're going to dive into London's capital markets with Deutsche Bank after the break. Plus, the H-1B fallout continues, with top tech CEOs weighing in on Mr. Trump's decision. We will discuss that too. It also says we'll discuss, lots of things. All things tech and AI with ServiceNow Chair and CEO Bill McDermott. That conversation is coming up in 1 hour and 12 minutes time on the dot. Don't miss it. Ørsted will resume construction of a wind farm off the coast of New England. This is fascinating after a judge blocked Trump's order to halt work. The project, it's 80% complete and will provide power for more than 350,000 homes. It's such a contentious issue, it really is. And I suggest you do some more work on it as well, because it's really, really interesting for future US energy policy. In fact, we spoke to a gentleman who represents the US nuclear industry last week, and he was very interested in that as well. London retains its global status as a financial powerhouse, according to Deutsche Bank, which recently put out, recent global trends increasingly supportive of UK equities. However, it warns the UK cannot be complacent about its ranking amid outflows from the London Stock Exchange and a modest IPO market. Henrik Jonsson is the co-head of capital markets and European investment banking at Deutsche Bank. Henrik, really fascinating. Look, I've been speaking to a lot of people about this as well, and there's two things going on. One, London as a powerhouse, two, the equity market. So I want to divorce those two if I can and start off with London, the powerhouse. I know full well, just up the road from here in London Wall, how much money Deutsche Bank has put into this as a powerhouse as well. But of course, you've got Feed in Manycamp, huge operation in Frankfurt as well. Why do you believe London's still in a preeminent position?
I think the data just speaks for itself, right?
Yeah.
This is still the largest venue for capital raising in Europe. It's sort of a factor of 2 or 3 times the size of some of the other bourses, and it's a destination for international capital, and we don't see that changing. We're the broker for 70 companies here through our Deutsche Numis acquisition. And so what we did is a survey asking leading members of their boards or CEOs what they think about London. And I thought the results were very interesting. I think one of the main conclusions is that the UK just needs to be very careful that ranking doesn't slip any further. And you see that in prospective IPOs. You had a guest earlier that was talking about Stockholm as a listed venue. And also the sort of general competitiveness and whether the UK is undervalued, which, as you would expect, every single CEO thinks that their company is undervalued.
Again, I'm sure we'll definitely bring that up in a moment as well. But look, let me come back to one of the key issues that everyone in the industry speaks about at the dinner parties now as well, and is whether London can still attract the talent, whether the talent wants to stay here. Because as well as it being about markets, it's about people as well. And having brilliant diasporas such as yourself parking themselves in London and being happy to do so. That's at risk if this government doesn't sort its act out.
I mean, that actually did come through in the survey, that ability to attract skilled people was a high-level concern. And it actually was one of the key recommendations from our report, that we need to continue to focus on that in the UK. I think generally when it comes to executive remuneration, that was also a theme in the report. And there, previously people have talked about the difference in remuneration between Europe and the US. I think a really important new factor is the difference between private companies and public companies, where obviously we've seen a big wave of take privates, especially here in the UK, a de-equitization of the market. And the potential rewards for running a private company, obviously unconstrained by public shareholder votes.
I just want to rake back over some of the companies that have left the UK market. I mean, we've seen them all in the headlines. Wise choosing the Nasdaq for its IPO, bypassing the London Stock Exchange in recent years. Just Eat Takeaway, CRH, Flutter Entertainment, Ferguson. I mean, there's a whole list of companies. What do you say to others that may be looking to follow suit, where they're looking at the opportunities stateside, they're looking at opportunities elsewhere in Europe? What do you say to them about the benefits of the UK versus chasing what look like greener pastures?
So I think the most surprising result in our survey was that I think it was 83% of boards had considered relisting somewhere else. And in a way that's not surprising, and it's related to the undervaluation point, because it's tempting to think that you can fix your undervaluation just by listing somewhere else. I think the facts don't actually support that, and that's why we're seeing that in very limited quantities, people actually acting on relisting. There's just hard work involved in terms of getting investors educated on your story, obviously doing operational turnarounds. So I don't think the relisting is much of an issue, but I think making the UK a more attractive place to invest is important. And I think one of the major conclusions of our report is attracting particularly domestic retail capital into the equity markets is something that the government really needs to focus on.
I hear you about convincing investors around the individual company story, but for a long while, the UK has looked not very compelling. But the stock market in recent times, you've seen a rally. There's been fresh interest and diversification away from US markets into the UK. You saw just the other week, Sir Keir Starmer with President Trump, the amount of investment money flowing through. Is it easier in 2025 to sell the case of an individual story because the backdrop has slightly improved, the optics have slightly improved?
It's much easier, and I think that's a very good point, because the dominant theme in capital markets, I would say, this year has been a reallocation of funds from the US market into the non-dollar market. You see it in gold, you see it in Bitcoin, you see it in European equities, and the UK is certainly getting its fair share of that, and you can see that in the returns. But at the moment, I would say that actually Europe, particularly Spain and Germany, are getting a bigger share of the flows.
Hendrik, in an ideal world, I've just got you a meeting with Rachel Reeves, and it's completely off the record, and you and her in a room, and she's going to do the first 3 things you tell her to do to re-galvanise the London market. And it's what are the 3 things? Well, the first couple of most important things. We've only got a minute and a half, so it's going to be what you're going to say to Rachel Reeves. Do this, maybe do this, and we will prosper in London.
Well, I'll take the safe option and say what our report says. I'm not sure if it's off the record if we're talking live on air.
Cut the stamp duty, Rachel. Come on.
But one, carry on with the proposals to make it easier to be a listed company in the UK.
Yeah.
That's a big one. 2, I think provide tax incentives for retail investors. As opposed to right now, we're providing tax incentives for them to stay in cash, which is the worst investment that a retail person can make. Compared over the last 40 years, equities have been a much stronger contributor to people's pension.